How do we rationalize all-time highs in the midst of a war with Iran?
Well, I think investors, as you know, focus a lot more on earnings and the next quarter and pricing in global geopolitical change and readjusting balance of power and the prospect of how long this war will continue is much harder for them to do. So once the momentum picks up, it's hard to not jump right in.
So you just pretend it's not there, or are investors about to learn a very difficult lesson? The bottom feeding, the buying the dip has been very profitable.
Well, I think that's the key issue, that the buying the dip has been very profitable up until now. I think the other thing is that there is a signal from the Trump administration that they want to do a deal, not to make this better rather than make it worse. I think they also have been listening to your programs and your guests talk about how things are going to get much worse very quickly if this goes on. And so the time isn't on the president's side to draw this out any longer. So I think they're betting on the fact that he knows that and that he will come to terms.
Well, when we consider the kind of economic picture overall heading into this, it seems, at least the picture that the big banks are painting as they reported earnings over the course of the last several days, is actually the consumers holding in there pretty well, that this decline in consumption due to the higher prices being faced, and even the ones that they're facing now at the gas pump, is maybe a bit overdone, Christopher. And I wonder if you agree with that, or if we could see at some point a rapid deterioration if this is to persist.
Well, we could certainly see a rapid deterioration, again, if this continues. And I think people are really looking at a 2 to 3 week time frame, that if this is not fully resolved, or at least significantly resolved, the reserves that other countries have been drawing down, the difficulty it's going to be to restart production again is going to be much, much worse. And so that's going to be a big hit. But I think for right now, as you say, the macro indicators look pretty good. The corporate earnings look pretty good. The meetings I've been having around town this week with the IMF and the World Bank, there are a lot of exciting companies doing some extraordinary things. And if you just don't listen to the political headlines, there's a pretty good picture out there.
But you should listen to the political headlines. That's what we bring you here on Balance.
You have to do some of both, right? But there is a good story that goes along with the much more worrying one.
We have a repeated analysis on the program that even if the war ended today, that it could take months for the energy market to rationalize itself, to get cargo going through, get shipping going through the strait again, to get prices back down to where they ought to be. We talked about the potential for physical shortages hitting Asia, hitting Europe. What's your read on things right now? If that's the case, even if this ended today, we could still be in for a lot of pain.
I think we could be, and I think that's why the next 2 weeks are going to be crucial to all of this. From my perspective, it's how much is the market? Not even the market; it's the guy who owns the ship with the oil on it. Going to trust whatever deal takes shape. And it's not so much the ships that are trying to leave the Gulf, but it's that empty tanker trying to go into the Gulf. How many of them are going to start lining up and trust whatever regime takes shape? Are they going to have to pay a toll or not? Is the U.S. Navy going to be there, or some European convoy to enforce the agreement that takes shape? How much is Iran, the Iranian government, going to be able to deliver on anything that it signs off on? And how much uncertainty remains in the price of oil? So I think it's certainly not going to go back to a pre-war level.
You don't.
But we're going to be looking at how quickly that kind of confidence is restored. And it's probably not going to be as quickly as people expect today.
Well, it's one thing to consider the picture here in the U.S. as the president is consistently maintaining we are less reliant on Middle Eastern energy products as a whole. We don't need the Strait of Hormuz. It's everybody else that does. There is some truth to that. For Asia and Europe, it's a much bigger problem. And I wonder if you see this whole thing as reinforcing that the U.S. is the best place to be, as there was a narrative of a rotation out of the United States.
Well,
are we seeing the rotation back?
As an American, I would always say that the U.S. is the best place to be. I would also say, as you have been to a gas station recently, that even if we have all of the oil that we need, it is as you know, this being Bloomberg, a global market. If prices are high in Asia, they're going to be high here. And as we go into the driving season, I think that's going to erode some of that consumer confidence. You've seen, it's this great dichotomy that we haven't fully understood. I don't think that as consumers continue to spend, their sentiment and their outlook continues to deteriorate. We had an all-time low, I think, on sentiment last week. Yeah, so that's something I think we're all going to be watching.
Well, so bring us into some of these meetings that you've been having here on this IMF week. Are you hearing an optimistic tone when you meet with people from other capitals? They're here in the United States against the backdrop of a war and enormous confusion in international markets.
Well, I have to tell you, I don't think I'm letting you in on a secret, but there's never an optimistic tone at the IMF meetings.
Okay.
There's always...
Compare it to other years.
First of all, they seem to be timed with previous crises, Ukraine.
Well, that warning we heard from the IMF yesterday was stark.
Yes.
Slowest growth since COVID.
It was. And I think that's a bell that they've been ringing for a long time now, that growth is slowing down. The new piece of the message is that inflationary pressures are not going down. In fact, it's quite the opposite. We heard that from Secretary Bessent. Chris Wright, the Energy Secretary, I think said earlier this week that anybody projecting lower gasoline prices by this summer is probably making an optimistic forecast. So I think the assembled investors and central bank and finance ministers are much more worried about these macro indicators than the financial markets would lead you to believe.
Well, the World Bank IMF meetings may happen during crises, at least in recent years. It also happens that this is taking place the week of tax day, which is
Indeed.
Today. We just had the Treasury Secretary, Scott Bessent. In fact, he's still at the podium at the White House, in part heralding the benefit of the One Big Beautiful Bill and the higher refunds Americans are getting. But given the entire conversation we're having about higher gasoline prices, other inflationary pressures, to what extent is a higher refund even stimulative at this point, Christopher? Is it entirely offset because the cost of things are higher?
Well, I think it depends on whether you actually get a refund or you are paying a lower amount of tax that you don't notice getting taken out of your paycheck. I think it's a balance. I think the good news, the tailwind for the economy is the One Big Beautiful Bill, the tax cuts, no tax on tips, the depreciation allowances. Those are all very, very positive tailwinds for the economy. Also, tariffs, there's uncertainty around tariffs, but they're not going to be nearly as high as we thought they might be last April. So that helps. But I think the oil price and the continued uncertainty is clearly something that's going to put a brake and a damper on business investment, business confidence, and that's going to be a headwind that the two are going to be, we're all going to be balancing.
Are you allowing for $120 a barrel again or higher if this ceasefire is not extended?
Oh, I think 120 is going to be optimistic if the ceasefire is not extended.
Wow.
I mean, when you're in the physical market, when you're in a financial market, supply meets demand, you make a deal, you sell the paper. When you're waiting for tankers to be unloaded of a physical good, $200 might be cheap if you're desperate for the oil. That's when you start getting the demand destruction in the U.S. economy and the global economy. So that's why the next 2 to 4 weeks are really crucial.
Well, I also wonder how this factors in as we consider the uncertainty around the next 2 to 4 weeks and beyond that into monetary policy, Christopher. You have the president today renewing his attacks on Chairman Powell, suggesting he's going to fire him if he tries to stay in the job, knowing right now his pick to be the next Fed chair, Kevin Warsh, while he has a confirmation hearing scheduled, is not on track to be confirmed because the Fed is still being investigated over the renovation. Therefore, Tom Tillis will not cast a vote to confirm Kevin Warsh. We're in the midst of all of this uncertainty around leadership at the Fed and around the actual macroeconomic environment. Is there any feeling from you that they're going to do anything other than stay put for the foreseeable future?
I think most investors look at today's news, the recent week's news, and throw up their hands and say, I don't know what to make of it all. But in any situation, it's hard for even Kevin Warsh to come into the room and look at the macro environment and say, we got to cut aggressively today. And I think more and more investors are pricing out or pushing back their expectations of rate cuts this year. And there's even talk of maybe the next move is going to be up next year, depending on how this all plays out.